Hello and welcome. In the previous video, we learned what a primary market is and what a secondary market is. Correct? In this video, we will learn more about them. Alright? Now let me take the example of our oil mill. You know that the friends had offered 1000 shares to the public. Correct? Now this was in the IPO. Now let us say that the high net worth individuals or rich people apply for 800 shares. Okay? And the financial institutions want to buy 700 shares, or they apply for 700 shares in the IPO. And let us say that people like you and me apply for 100 shares. Okay? That is, one person may apply for 5 shares, another person may apply for 10 shares, and so on. Now there is a minimum quantity for this. Okay, there is a minimum lot size which we will not consider now. We will take it as 100 shares collectively. Alright. So people like you and me apply for an IPO and the total number of shares applied for is 100. Alright. Now you can see that the friends have only 1000 shares to offer. But you can also see that we have 800 plus 700 plus 100, which is 1600. So there is a demand for 1600 shares when there is a supply of only 1000 shares in the IPO. Right? So when the demand is more than what is being offered, the IPO is said to be oversubscribed. Okay? So when an IPO is oversubscribed, a computer automatically allots shares to people. Alright? It is like a lottery system. The computer randomly allots shares. However, this lottery system works within separate reserved categories set by the regulator, that is SEBI. For a typical IPO, at least 35% of the shares are reserved exclusively for retail investors, meaning people like you and me. Institutions and HNIs get their shares from different separate quotas. This means that retail investors are only competing against other retail investors for their dedicated portion. If this retail portion is heavily oversubscribed, the lottery gives each applicant a chance. But then not everyone will get an allotment due to the high demand. Alright. Now, this primary market is also known as known market, because we know from whom we are buying the shares and the promoters know to whom they are selling the shares. Alright. Of course, they may not know everyone by name, but they know who they are selling their shares to. For example, let us say 200 shares get allotted to high net worth individuals. Okay. The promoters know who the 200 shares have gone to, and those individuals know the shares are coming from the promoters in the IPO. Since buyers and sellers are known to each other, this is known as a known market. And when I say known to each other, it is not as in friendship. Okay? It doesn't mean that these promoters know the investors like family. It is not so. It is just that they know to whom they are selling the shares. Okay? Next, coming to the second condition. 1000 shares are being offered in the IPO by this company. Let us say that the high net worth individuals apply for 100 shares. Financial institutions apply for 200 shares. And people like you and me apply for 500 shares. Alright? So 1000 shares are being offered, but only 100 plus 200 plus 500. 800 shares are in demand. Okay? So when the offering is more than the demand, the IPO is said to be undersubscribed. Okay? Now there may be many reasons for this. Maybe the shares are being offered at too high a price, or the investors may not have confidence in the company, or they do not know about the company, among other reasons. For whatever the reason, if an IPO is undersubscribed, then everyone who has applied for it will get shares allocated to them. Okay? Well, if an IPO is undersubscribed, then the company does a few more things which we will see later. But then you can think or assume that everyone gets shares. Okay? That means these people will get 100 shares, the institutions will get 200 shares, and retail investors get 500 shares. Okay, so when an IPO is undersubscribed, everyone gets their shares. When it is oversubscribed, it is a lottery system. So not everyone may get shares. Alright? Yes. Next is our secondary market. Let us say that an IPO is completed and people have got their shares. Alright. So once the IPO is done and shares are allocated, they can be bought and sold on the stock exchanges through stock brokers. Generally, after a few days after the IPO, the shares will be listed on the stock exchange, and from there others can buy and sell the shares. Okay? This secondary market is also known as unknown market. This is because if you want to buy shares of a particular company, you will not know from whom they are coming from. Or if you want to sell shares on the market, then you will not know to whom you are selling them to. The transaction happens through a broker and the exchange, so the buyer and seller remain unknown to each other. The buyer doesn't know from whom he gets the shares, and the seller doesn't know to whom he sells the shares. This is why the secondary market is known as unknown market. Okay? people like you and me buy from the stock exchange through a stock broker, right? In the secondary market, in the unknown market. All right? Yes. I hope you have understood the concept. Now, let us learn the term equity. Okay? Now, you know the difference between a share and a stock, right? What are shares? Shares usually refer to units of ownership in a specific company. For example, you can say that you own 10 shares of Tata Motors. Here, there is only one company involved, right? What are stocks? Stocks is a term generally used to refer to ownership in multiple companies. For example, let us say that you have shares of Tata Motors, shares of Infosys, and shares of Ola. You would generally say that you have stocks of various companies. Shares correspond to single company, stocks correspond to multiple companies. Alright? And then comes the equity. Equity is the term for the total ownership stake in a company. For example, if a company has 10,000 shares and you own 1,000 of them, you could say you own a 10% equity stake in that company. Okay? So, equity is the ownership percentage. Shares are for a specific company and stocks are for multiple companies. But then, generally, people use these terms interchangeably. Okay? You can use them interchangeably, but it would be better to know the difference between them. All right? Yes.